Hello and welcome to today's video with discussing trading strategies presented by spreadbettingportal.com. In this video we're just going to be covering some common strategies for success. Now, one of the key things with trading and finding trades is making sure that what you're doing is easy to understand. That whatever it is that you begin to use, that you don't begin to see that you're adding more and more indicators or oscillators or techniques and methods and this, that and the other. The idea is that when you look for trades, that the tools that you are using help you and don't cloud what you're seeing or don't hinder what you're looking for. And one of the things that you have to really understand as a trader is all you are looking for is a change in sentiment. That's all we are looking for. And no, there is no indicator, technique, method or anything like that that can really tell you the future. Technical analysis is not a crystal ball. It doesn't offer you the ability to look ahead and say for sure that that's going to happen. All that technical analysis does, if done well, is give you the ability to just load that dice a little bit in your favor, possibly. And if you can be right more than you are wrong, then you will be a successful trader. So if you're right 55% of the time and only wrong 45% of the time, then you will be a very successful trader. So it's understanding that when you are using strategies or tools or techniques or methods, that when you look at a chart, you're not just going to be looking at one chart. The chances are you're going to be looking through lots of charts to find opportunities. To be able to do that effectively, you have to understand analysis pretty well, but you also have to make the chart in which you're scanning very easy to understand. So if you have a small amount of clutter on there in terms of the tools that you're using, and then you also understand that all we are looking for is a change in sentiment, whether it's consolidating, going up or going down. That's all we're looking for. So it's about keeping it simple. And one of the ways of trying to keep it simple, and one of the pretty much one of the first sort of indicators that appeared, but in fact is one of the key ones still being used by pretty much every trader, is that of the moving average. A moving average is basically a line that tracks the average of the price over a set period of time. It's a lagging indicator. That means, say, if we have a 20-day moving average, it takes the period of the last 20 days and levels them out as an average in an ongoing way. And this plots a line that tends to either sort of be trading above or below, or moving above or below where the price of the live chart is. And this lagging indicator, when used as a group, when you have a group of moving averages set at different values, it gives you signals which are called crossovers. And these crossover signals act as buy or sells, or where you go long or short, for instance. And one of the most common ones, very popular in fact, is one called the golden cross. It's very simple to set up, and we'll explain how to do that. First of all, you have to wonder, it's a 2 times simple moving average. So there's 2 simple moving averages there. One is a 50-day simple moving average, which you color in red, or any particular color of your choice, but usually it's red. The next is a 200-day simple moving average, which is a green. And essentially, when the 50-day moving average green one crosses the 200-day moving average, the green on the bottom and the red on top, that signals a buy when that crossover happens. And the reverse is true. The 200-day red moving averages crosses down over the 50-day green moving average, red on the bottom and green on the top, that signals a sell. Now we'll cover that in more detail in a moment when I show you an actual chart. But why is it the 50-day moving average and the 200-day moving average? Well, the 200-day moving average is the general consensus is that if the trade is if the chart is moving through a 200-day moving average, that usually is an indicator known throughout the sort of trading world as usually a sign of a change in true sentiment, a change in trend. You know, whether the trend is going up or down or sideways, a consolidatory trend. So the 200-day moving average is used for that. The 50 days is a shorter term one, and again that's a very similar one, and that usually shows change in sentiment. So if you see the 200-day as a change in the trend, which is the long-term view of where a chart is going up or down, and then the 50-day simple moving seen as a sort of an indicator into the change of sentiment, whether sort of over the period of days has it been predominantly bullish or bearish, you know, up or down. And when these cross, they act as quite a powerful sort of indicator as to where there's been a massive change in sentiment, and this change in sentiment has caused a swing in the trend. And there's an old saying, let the trend be your friend. So you know, you always try if you can to trade with the trend. So we'll cover this in a bit more detail. So here we have the 50-day moving average, and you can see from the little sort of cross and little arrow here, so we have the 50-day moving average, and then we have the 200-day moving average in green. And as you can see, there's quite a wide difference, and obviously the difference, this width is created by the differences in value. So one is closer to the actual trailing of the live price because it's a shorter moving average, and the one is further away because it's a much larger number in terms of the moving average. So really what you're looking for with these is where there's a real change in sentiment. So you really probably wouldn't do a huge amount along here, although you could, but you would begin to possibly trade along this line where you get this crossover here and then you go short. Now of course, you know, there are points where you would have been knocked out of the trade, possibly there, and we'll discuss stop losses, which most people use to protect, and I would recommend everyone use to protect a trade. Basically, if a trade goes in the opposite direction, it's a stop value where the trade is closed at a particular value. And you can set, usually in a lot of brokers, you can set what's called a trailing stop, which you can sometimes base on a moving average. So a lot of people tend to use a 50-day moving average stop. So as you can see here, we've got this sort of change in sentiment and then a change in the trend, and over the long term, sort of almost a whole year, it went down. And then we get this period of sort of slight consolidation, nothing hugely happening here. On a technical note, there's what's called a head and shoulders here. Those of you that understand what I'm talking about will know what that means. And then we get a real change again. We get this bullish move going back up, and then from around about July 2009 going back up again, and then obviously you'd get stopped out around about October on that. So there are ways of just using this simple golden cross to trade, you know, relatively long term. And that's really what you have to understand, is that the golden cross is a long-term trading method, and as a result of that, it requires a large stop point loss. You know, as I said, a stop loss is basically a point where your trade will close automatically. And so that with it being a long-term trade, it's tying up capital that you obviously can't use on another trade because it's been signaled in for that trade, and because you have a wide stop, you're probably devoting more margin to it and so on. So so you have to understand the positives as well as the negatives, and the negatives is that for sometimes your trade can actually be negative in value for long periods, and you have to have sort of really get a real guts to keep the trade open and not stress about the fact that it's been negative for so long, and trust in the whole sort of theory of the golden cross and that eventually it will move positive. So it requires this ability to trust in the long term. And the other thing is that it only works in long-term trending markets, and that's why it uses those two key periods, the 50-day moving average and the 200-day moving average. The next thing we'll look at is what's called swing trading. Now, swing trading doesn't really result on trends, but large periods of consolidation. Now, consolidation is basically a period where the market is going sideways, but is trading within ranges. So there's an upper range and a lower range, which I'll explain more about in a moment. And what we're looking at is, within these ranges, we're looking at trading the extremes of those, where there is a change in the sentiment and it goes down, hits the support where it's changed previously and gone up, and then we close the trade and go bullish. So the theory is we're looking for long range or large ranged consolidations. We're looking for very strong supports and resistances, and I'll explain what all those are in a minute when I show you a chart, show you how all this is set up. And by finding these strong supports and resistances, if you just see a support is a point where a price has fallen to a same level over and over, and this is added support. A resistance is the opposite of that. It's where a trade has gone up in value but fallen from, and it's reached this same value over and over, and this acts as a resistance. So hitting a resistance opens a short trade, a trade that profits from a falling market. And hitting a support opens a long trade, a trade that's basically positive in nature and profits when the market's going up. And stop losses are usually placed just outside these supports and resistances to protect against any sort of adverse moves. So here we have the FTSE chart, and here we can see a resistance here, just at the long, up at the top here, and a support here. Now this support is generated by these three key points. There's one that's just dipped a bit below, but the three main points are there. And then the resistance really is a bit stronger than that. So we have these key points here, and what you're looking is points where, say if we were at this point in the chart, and if we ignore this data here, and we're just coming up to here, we would be looking to go short because it's starting to reach the resistance, and then we'd be looking to go short there. If we were, as it was going down, and we were looking to possibly place a bullish, a positive, an upward trade, we would look at where it's hit support previously, and then we would look to go long on it. So as you can see, we look at points where it's hit the same price over and over and fallen from. That creates a resistance. If it's creating a resistance, it's likely that it's going to happen again. So by finding out where it's starting to reach that point again, we look to begin to place a short trade once it's hit, and then we place a short trade and it goes south. The stop loss we always place outside, just outside of these supports and resistances. So our stop loss on a short when it's hit resistance would be just above the resistance line, and if it was a long trade we would put the stop loss below the support, just there, and then begin to move it up relatively quickly as soon as we're beginning to profit. So swing trading can be a great way of trading because it's a means of, it's more short term than the golden cross. There are periods in any market where there's a period of consolidation, and usually these are quite wide. So it is it is quite easy pretty much to find these trades. One of the things you have to be aware of is that swing trading, the methods are so varied. The one I've explained to you is the most common, is the most obvious, because swing trading pretty much does rely on the fact of support and resistances. That's all you really have to remember. Now there are all sorts of tools and particular methods and tools designed for finding swing trades, but all they are doing is finding supports and resistances, which if you're any good, or should be by the time you've studied analysis enough, you should be able to spot with your own eye supports and resistances. If you can't do that, then you're going to be in trouble as a trader. So you should be able to find supports and resistances with your own eyes, and if you can do that, you can then trade swing trades, and you don't need all these fancy tools that cost hundreds of pounds sometimes, you know, even thousands of dollars, that just basically tell you what you can see with your own eyes. And some of the other methods are more short term, that run over, you know, some can run over just a few hours, and depending on how fast the market's moving, and others are slightly longer term, sort of weeks, days and weeks, like the one we've shown. Sometimes it can last months as well. But so is it any good? Well, the better ones, as if you're a patient, are the longer term swings based on strong long-term supports and resistances. These work best. If you can find, like we showed in the chart, sort of long-term supports and resistances, because they're long-term supports and resistances, there's a chance that they're likely to happen again. So it's being aware that, you know, if you're going to do it, certainly in the beginning, you're probably best looking at a longer term swing based on a long-term support or resistance. Be prepared also to have a pretty wide stop to allow for movement beyond the trade during the swing, because obviously the market doesn't always continue to go up. So a lot of people make, certainly beginners make a big mistake, as they start to see profit, and their fear of losing any bit of that profit, they move their stop right close to where it's trading, and obviously, you know, it's going to get stopped out quickly because the market still fluctuates, even though it's still predominantly bullish or bearish, going up or down. The market still moves within the day within that. So yeah, don't place your stop too close. And of course, you know, it does still require some skills. It does require good skills and ability in finding supports and resistances and knowing when to trade. You know, nobody gets in at the top or the bottom of any market. So don't ever expect to get right in at the point where it's turning. And in a lot of ways, you kind of don't want to do that, because a market can quickly turn the opposite way. So what next for you? Well, just remember that there are many methods in trading. We've just covered a small number, which are the most common. But you'll find that a lot of the methods that are available to you as a trader sort of mirror these most common methods of trading. They're variations of. So once you get and understand that you know, it's really just about finding change in sentiment and finding supports and resistances. Those are the key aspects of any market, and that's the sentiment and the supports and resistance. Once you learn how to find those, then you're golden. Then you're on your way to you know, being a good trader, because those are the key things. The most common mistakes I tend to see with traders is those that adopt too many methods and techniques and charts and indicators and oscillators and this, that and the other, and they're adding it, and their charts are just a real mess. It's like a spider's web of information that you just can't see what the hell is going on. So it's about keeping it simple, understanding the fundamental things with trading, is that it's looking for a change in sentiment, and that you're looking for supports and resistances, and those alone will arm you more than a lot of the so-called black box trading tools and methods that are out there. So we've come to the end of this video. Don't forget to stop by and say hello to us at spreadbettingportal.com, where we've got loads more videos, some brilliant articles on trading, and some of the latest and amazing deals from the leading brokers too. So come and visit us now.